The dollar should have collapsed by now. By every metric the dollar bears sight, debt levels, money printing, geopolitical rivals, de-dollarization. The dollar should have been replaced years ago. It has not been replaced, not because those problems are not real. They are real, but because the alternative does not exist yet. And until it does, the dollar survives not on strength, but on the weakness of everything around it. That is a much more uncomfortable truth than collapse, because it means the system limps forward, neither fixed nor broken enough to force a change, while the people inside it absorb the slow cost of a currency that is declining without collapsing. This is the wealth files. Do you trust the dollar, or are you already hedging against it? Tell me below. There is an entire industry built on your fear of the dollar dying. Gold dealers, crypto exchanges, de-dollarization newsletters at $299 a year, macro podcasts with ominous background music, and guest lists that have been predicting imminent dollar collapse since 2009. The ecosystem is large, professional, and extraordinarily profitable, and it has every financial incentive to keep the fear alive regardless of what the data says. Because the moment you stop believing the dollar is about to collapse, you stop buying what they are selling. Meet David. Converted a significant portion of his savings to gold in 2011 at approximately $1,900 per ounce, following 18 months of dollar collapse content that told him it was only a matter of time. Gold then dropped to $1,100 and stayed there for 5 years. David broke even in 2019, 8 years later. Having missed the entire equity market recovery of the 2010s, he was not wrong that the dollar had problems. He was sold a timeline that did not exist by people who profited from him believing it. The dollar has problems. The timeline is the lie. The dollar currently represents approximately 58% of global foreign exchange reserves. That number is down from 71% in 2001. A genuine, measurable decline that the de-dollarization narrative correctly identifies. What the narrative does not tell you is that the next largest reserve currency, the euro, sits at approximately 20%, then the yen at 6%, then the pound at 5%. The yuan, the currency that BRICS nations, geopolitical analysts, and crypto advocates have been positioning as the dollar's replacement, sits at approximately 2%. 2%. After a decade of China actively pushing for yuan internationalization, after BRICS expansion, after Russia's forced exit from the dollar system, after every sanctions episode that was supposed to accelerate de-dollarization, 2%. The yuan cannot replace the dollar for one structural reason that no amount of geopolitical will can currently overcome. It is not freely convertible. To hold yuan as a reserve asset, a central bank needs confidence that it can sell those yuan when it needs to, at a price set by a market, not by the People's Bank of China. China maintains capital controls, because opening the yuan to full convertibility would expose its financial system to outflows it cannot absorb. Until those controls are lifted, the yuan is a bilateral trade currency, not a global reserve. China knows this. Every central bank knows this. The de-dollarization narrative often does not mention it. The euro has the opposite problem. It is freely convertible. It is widely held, and it is backed by 17 different sovereign governments with 17 different fiscal positions, 17 different political systems, and no unified treasury capable of issuing the risk-free asset that reserve currency status requires. The euro crisis of 2010 to 2015 demonstrated exactly what happens when a reserve currency candidate does not have a single sovereign behind it. Nobody who watched Greek yields spike to 35% in 2012 concluded that the euro was a more stable reserve than the dollar. This is the trap the dollar sits in, and the trap that keeps it alive. It is not the strongest currency in the world. It is the least bad option in a world where every alternative has a disqualifying structural problem. Reserve currency status is not won by excellence. It is held by default. The British pound was the world's reserve currency for nearly 2 centuries. It did not collapse. It faded, slowly, over 50 years as the British Empire contracted, as American economic dominance expanded, as the Bretton Woods system institutionalized the dollar's primacy. People living through that transition in 1930 or 1940 or even 1950 did not experience a collapse. They experienced a slow, grinding loss of purchasing power and geopolitical influence that most of them never fully understood while it was happening. That is what dollar decline looks like if it comes. Not a crash, not a moment. A decade-long fade during which most people will not know whether to act or wait, during which the people selling collapse products will grow richer, and during which the actual cost will be absorbed quietly by the purchasing power of everything you hold in dollars. The U.S. national debt is approximately $34 trillion, over 120% of GDP. The interest payments on that debt are now the largest single line item in the federal budget, exceeding defense spending. The Federal Reserve expanded its balance sheet from under $1 trillion in 2008 to nearly $9 trillion by 2022. These are real numbers. They represent real structural problems that have no clean political solution. And yet, when a financial crisis hits, when markets seize, when banks wobble, when geopolitical shocks send investors looking for safety, the dollar strengthens. Every time. 2008, 2011, 2015, 2018, 2020. The world's most indebted country issues the world's safest asset in a crisis because the alternative is holding something worse. The dollar's survival is not a vote of confidence. It is a vote of no confidence in everything else. What this means for you is more specific than the macro analysis suggests. The dollar is not going to zero. The people telling you it is going to zero are selling you an alternative. But the dollar is also not stable. Inflation is the slow tax on every dollar you hold in cash, in a savings account, in a money market fund. The Federal Reserve stated 2% inflation target, which it consistently overshoots, means that the purchasing power of a dollar held in cash halves approximately every 35 years. You do not need a collapse to be damaged by declining currency. You need only to hold it passively while it erodes. The uncomfortable conclusion is this: the dollar will survive longer than the collapse narrative says. It will decline faster than the dollar bulls admit, and the people profiting most from both those facts are not the ones warning you about it. They are the ones selling you the hedge. Protect purchasing power through assets, not out of fear that the dollar will collapse next year, but because any currency managed by a government with a $34 trillion debt has a long-term structural incentive to inflate. Own things, productive assets, real estate if you can access it, equity in companies that produce things, not because the system is about to break, because the system is designed to slowly, quietly, continuously transfer value from the people who hold currency to the people who hold assets. That transfer has been running for 50 years. It will keep running, with or without the dollar. If this changed how you think about the currency you hold, the next video goes further. Not just the dollar, but the entire system of central banks that is running out of tools to manage what comes next. Hit subscribe. This is the Wealth Files.